The world of wealth is undergoing a massive change due to, one, the rise of AI and LLMs.
Within a year or two, the S&P 493 companies start telling you that they're beating earnings, and the reason why is productivity, and the productivity is stemming from the use of AI.
And two, a generational wealth transfer. $90 trillion flowing from boomers to millennials and Gen Z. So on number one, AI. If you look at the previous tech platform shifts, like the rise of internet, cloud, and mobile, they did not have a particularly large impact on the world of wealth and RIAs. That is not going to be true of AI and LLMs because the unique affordances of this new model and new technology will impact how financial advice is delivered. And then two, if you look at the generational shift, about $90 trillion of wealth is going to start transitioning from boomers to millennials and Gen X over the next 20 years. Those new clients have different expectations about how wealth advice should be delivered and what financial services should look like.
The way that their lives are structured, they don't have as much time to read. One of the things that you've seen us do is pivot to multimedia.
So we're at the cusp of two very big trends changing how the world of wealth will operate. To unpack those trends, I have joining us today Josh Brown, the founder and CEO of Ritholtz Wealth Management. Ritholtz serves over 4,000 families and has $4 billion in AUM. They're seen as an industry leader and an early adopter of technology and even do angel investing in and around the ecosystem. Josh himself is a popular financial commentator, serves as a CNBC contributor, is an author, blogger, and has over 1 million Twitter followers. This is going to be a great conversation, so let's dive right in. Fun opener, ChatGPT. How are you using it at work?
Here's something that's really interesting, and I think it'll be solved. There are a lot of announcements from large firms that have built their own, I guess you'd call it an instance of ChatGPT, and they're kind of like these gate-kept pools of information that the AI knows it can utilize, and then it can't go outside the fence. And I think that first iteration on the street makes sense. It's really dangerous to tell if you're Morgan Stanley, you need to take what's great.
And Morgan Stanley did this specifically. They built their own version
Correct.
with OpenAI. We actually recorded a podcast with the OpenAI folks about how they did this with Morgan Stanley. It's crazy. They rolled it out to all of their advisors in a year, which even if it doesn't work very well, for a big firm to adopt a new tech platform like that quickly, even if it's not amazing, that's pretty impressive. That didn't happen with mobile, cloud, internet.
Well, when you realize that Morgan Stanley could probably keep itself from hiring an additional 3,000 paraplanners to support their advisors, you realize it's every bit as much forward-looking as it is being very realistic about the present. Like, how can we drop more money to the bottom line? So I think what they did is smart, though. You can't keep. All right, this is what I've learned. I'm doing this 25 years. I swear to God, this is a true story. I sat in a meeting in 1998 at the brokerage firm I worked at, or it might be 97, and the head of the firm came to the front of the room, and he said, "A few of you have been asking me about the firm's official policy on email." I kid you not. Here's our policy. No fucking email. You are not to write an email, receive an email, talk about email. You're not going to have an email address. We do not do email. And you could understand why. It was FINRA, which at that time I think was still called the NASD, and they had these very stringent record-keeping rules. And the last thing the firm and its compliance department wanted was to have another avenue through which people could put things in writing, or clients could complain about their advisor, or anything that represents a new thing that needs to be policed. And then there was another meeting, like a month later. Okay, due to client demand, we have decided there will be a firm email address, and all of your clients can send emails to that address. And if they say it's meant for you, we will print it out and we will bring a copy to your desk. And that was the policy. And then another month went by. They said, all right, you know what? Actually, we're going to let you guys have email addresses, but you cannot send an email until you print out what you want to say, bring it to compliance. There will be a wet ink signature. We will put a copy in a manila folder, and then you could press send on the email. And this went on and on and on. And eventually there was a surrender. It was, all right, you know what, guys? You can send emails, but also we hired an archiving firm through our IT outsourcer that's going to be scanning every email and storing it. And then actually we're going to read these emails with computers and we're going to know exactly what you're saying in real time. So that was the evolution.
Yeah.
It always, Rex, in my business, on Wall Street, it always starts with no. And it always eventually gets to a place where it's like, we can't ignore the outside world. We have clients that are very comfortable with this technology. Therefore, we have to enable. Okay. So that's that now.
And eventually you get to yes. It takes a while. So this was 1999. First major email service with MSN Mail was like in 1989, 1990. So we're talking 10 years to get to yes.
But what I want to say is, for the most part, the adoption of technology on Wall Street is always in response to what clients want, and then secondarily to what employees are comfortable with in their personal lives. So it's like BlackBerries. Like this is very common. Morgan Stanley kind of broke the mold. Instead of waiting 10 years and saying no, they said, all right, we acknowledge this is coming. And on the underwriting side of our bank, we're raising a lot of money for companies that are doing this. On the research side of the firm, we're covering NVIDIA. We can't ignore that this is going to happen. So rather than spend 10 years fighting it, what if we get out ahead of it and we engage with the leading technology provider and we build our own version? And it was really smart. And
what do you think
changed?
Work. Like, why with AI did Morgan Stanley say yes within, call it a year or even less from the ChatGPT moment versus 10 years for email?
So they don't have to hire everyone's nephew and everyone's son-in-law to be PowerPoint, to be like
So it's a cost
Excel
measure and
jockeys
they can see it.
for senior advisors. The thing about AI, what I'm most excited about with AI, I know it leads to revenue growth for the hyperscalers. I know it leads to revenue growth for NVIDIA. I also know it leads to a lot of cost and a lot of spending. But what I'm optimistic about is within a year or two, if it really has the amount of promise that people seem to believe it does, within a year or two, you're going to start seeing the S&P 493 companies, not the FANGs, start telling you that they're beating earnings, and the reason why is productivity, and the productivity is stemming from the use of AI. So we heard Domino's Pizza CEO on a conference call last quarter say they just made a $45 million investment in AI. Does that make the drivers more efficient? Does it better space out the time between when the product is ready? Does it enable the stores to do more local marketing? Does it answer the phone instead of a person? Whatever the reason is, I have a suspicion, not a suspicion, I have a hope that Domino's will tell us a year from now how much more productive they are and more profitable, and it will be because of the upfront investment they made in AI. Replicate that across the 3,000 publicly traded companies in the United States, and you got something. So
I totally agree. 2025 is going to be amazing to actually see if the rubber meets the road.
Yeah,
with some of these productivity gains.
So let me tell you a funny thing that happened last quarter.
This is also the opposite of every other tech shift, which is you never saw the productivity number go up, even though we had 30, 40 years of internet. This is, a whole, like, the rise and fall of American growth. We actually had a slower last 3 decades of productivity growth, and this might be the first platform. I want to back up, though. So I think we are probably going to see that, but, why did they decide to lean in? And I've heard a couple different theories, so I want to hear your thoughts here. One is, they just learned. There were 3 other shifts, and they're like, okay, we get how technology works now. 2 is the demo was amazing. It was this visceral demo you could do with ChatGPT 3 in a way like an email. It's like I can do a phone call. Cloud, so abstract. It's so that back office room that I never went into is now in the cloud. I don't even know what that means. Whereas this is I can see it, I can feel it, I can touch it, even if it's not perfect. So I'm curious, why did they lean in this time?
So let me give you an idea of what a typical day for a financial planning firm looks like. Morgan Stanley is obviously, it's 20,000 advisors, but just a typical financial planning firm. You have a calendar. Your calendar is filled with client meetings. If you're going to get on the phone with a $10 million household, you better be prepared with notes on everything that happened in the prior meeting and what actions have been taken since. So that's 30 minutes to an hour prep. Then you get on the meeting, It's an hour. Then you come out of the meeting, it's an hour of debriefing other team members, sending instructions to your administrative assistant, sending instructions through Salesforce for different tasks. We need to open an IRA. We need to fund a beneficiary. We need to do this. We need to do that. Philanthropic. We're missing this piece of paperwork. So that's an hour.
Just entering that notes and like the structured data into your CRM.
And then just keeping everyone abreast of what happened and making sure that you're in the CRM saying, we had this call. These are the 10 things we discussed. These are the actions that are being taken. So that's an hour of FaceTime with the client, which is the only thing the client's really paying for, by the way. And then an hour on the front end of prep, and then an hour on the back end. It's 3 hours. What if there's an AI note taker riding shotgun in that meeting, whether it's Zoom, which is very general,
or even before the meeting, it pulls up like the contextual information it can do. Like that's a problem.
Or it's a purpose-built AI, which we have 10 of them now. There's Jump AI. There's all sorts of programs now being written specifically for wealth management, and there'll be a couple of winners there.
Yeah.
So now I just took the typical financial planner who is a very highly paid, high-value employee at a wealth management firm, and I just gave him or her back 3 hours of their day that they can use to provide more face-to-face contact with clients, which is what the clients are really paying for. And not only that, I probably eliminate the need for the 23, 24, 25-year-old hire who's not going to be profitable for 10 years, who's basically there to do all of this prepping and instructing and follow-up. If a lot of that can be automated, and by the way, there's a compliance component to this too, which we could talk about.
And there's so many things to unpack here. Like if you don't hire that 20-something to do grunt work, where does the next generation of advisors come from?
We'll talk about that in a second.
I mean, there's so many other threads to pull on here. But
so from a compliance perspective, though, Rex, like if you own the firm or if you run compliance at a firm and you see that right after the call ends, the AI automatically summarizes the most important things that happened in the call and sends out that blast, then you know the client is fully aware of what happened on the call. It matches up with what the advisor says. The firm knows what happened. The follow-up tasks can then be checked by AI to see if they actually happened. Yeah. And we're talking to a startup right now. I can't reveal the name, but like they're able, using AI, to pinpoint the moment the mood changes on a call, the moment the client veers from optimistic to nervous. And armed with that information, a skilled financial planner can literally work wonders for that family, knowing exactly when there's a tone shift in the conversation, what made them nervous. Yeah. This is something that very skilled financial planners can pick up on naturally, but most can't. And that's where we're going. And so it's very exciting. I think the note-taking piece probably gets commodified pretty quickly. You'll see Salesforce.
Let's go there, because this is one of the things I wanted to talk about is there's a bunch of ways you could, just for the note-taking piece, which sounds banal, but is the tip of the spear in terms of connecting with everything else. You can take the Morgan Stanley approach. You can build it in-house on top of OpenAI. I think the big benefit there is you get access to your walled garden of data without having to permission a third party, but you have to build it. The second is you can buy a general purpose note-taking solution as a smaller RIA, but it's maybe not customized for wealth workflows, and maybe it doesn't have direct API connectivity to the fragmented wealth advisor tech stack. Or third, you could buy a wealth-specific version of this note taker that does have that connectivity and is kind of trained. So like, where do you see, I mean, Morgan Stanley's clearly chosen the first. There's kind of this middle ground and maybe some other, and then there's third, which is customized tools. So like, where do you see people starting to build? And I know you're early in this too, right? Like as a firm evaluating these tools, as an individual playing around with ChatGPT.
Yeah, we met all these firms. We know what people are working on. We've invested in a bunch of things, but we are not utilizing any of it. And I'm going to explain to you why.
Yeah.
I'm an early adopting idiot. Every time something new comes along, I have to blog about it. I have to tweet about it. I have to try it out. I have to evangelize what's good.
Yeah.
It never ever works in your favor in my business to be early, because the early version is never the best version. And this is the thing that no one will tell you, but I will, because I can't help it. When you early adopt and you're public about it, you get an SEC examination. There's going to be an SEC examination of every firm that has in their literature or in their Form ADV Part 2 or anywhere in writing that they're using AI. The SEC is going to say, oh, are you? Interesting. Tell us more. Here's a 100-question questionnaire. You have 30 days to respond in writing. Tell us the nature of the AI. What are the safeguards? What are the... So I've been through this twice already. When the robo-advice thing happened in 2012, we were very early. I think by 2014, we had launched our own robo-advice platform for small clients who wanted to work with us. We used a third-party software provider, which has since been acquired and orphaned. Now we're working with Betterment. But like in those early days, we were the idiots writing blog posts about how we're doing robo-advice. And the SEC said, oh, are you? We'll see you soon. And then they do a sweep. What I'm describing is what's called a sweep. And they look for every firm that's publicly talking about robo, and then they come in with a questionnaire, and then they follow up with an examination. Nothing wrong with that. You're going to get examined anyway. It's not something that you want to do all the time. So you answer. By the way, we had $2 million on this robo platform. We spent 2 months talking to them about it. So that's what you get for early adoption. And as if that weren't enough, when crypto came along, idiot that I am.
Yeah, you blogger out.
We did the same thing. We launched a crypto index, basically like an SMA with Wisdom Tree. It was probably not perfectly timed. We did it like right at the end of the crypto rally of 21, right before the Sam Bankman-Fried stuff came out. Crypto is higher now, and the clients are fine. But I'm saying, like, we had to be the idiots who went out with a press release that we're doing crypto. And guess what? Right on cue, sweep, we get caught up in the sweep, and boom, we're in another 5-month examination. There's, again, nothing wrong with being in an examination, but the toll that takes on your compliance people, it's incredible. They're working till 10 o'clock at night responding to endless questions. We made zero money on Robo the year it generated an examination. We made less than zero money on crypto. It was so tiny, I don't even want to tell you the number of the amount of clients who invested in it. Both just complete and utter waste of time. Now, we still have clients invested in crypto to this day. They're fine. We have now 40 or 50 million in assets on the Robo platform. Great situation. But my point is, there's no award for being first. Pioneers get the arrows in the back. We sit back and wait.
Especially in financial services with adopting new technology.
You have to be an idiot to run around screaming about how you're on the bleeding edge of technology publicly as an RIA. Nobody in Washington claps for you. And by the way, they're doing the right thing. That's exactly what the regulators should be. When there's an emerging technology, they should get their arms around. Well, how are people
I don't know if I would say
it?
exactly the right thing. There are elements
they're
of
not
it
punishing. So they're not. What they're not doing is punishing. What they're doing is they're making sure that these new technologies are not putting investors at risk or putting the financial system at risk. And you could disagree with their stance on Ripple and all. I don't get into that stuff. My point is, we will adopt the right methodology of incorporating AI, both for advisor use and for client use within our practice. But there is no race, and we're going to watch a whole lot of car accidents, and we're going to drive by those car accidents contented to just say, ultimately, this will be ready for prime time, and then we will make big decisions. But we ain't going to be first ever again.
Yeah, I think it's one of the hard things for founders building anywhere in technology around financial services is you face what is true for everyone building in tech, which is you need to find early adopters. And early adopters are even more shut off by fear about regulatory recrimination.
Well, I try to balance we're seen as a cutting edge firm, and I think in many ways we are. I try to balance that ethos of the willingness to try new things. So we have an angel fund where we've made investments in some of these early AI startups. I think to some extent we can play kingmaker. We throw the biggest wealth management festival in the world, basically once a year. We have demo drops. We have the ability to get a lot of eyeballs on a product. There are companies like Ritholtz and Vestwell where I was an advisor and a shareholder, and the firm was a user. And these companies have had unbelievable success. I hope that I played some role in that. So we're not Luddites, but we also recognize there is no financial advisory firm that ever wins anything, market share, renown, anything for like being the guinea pig for a tech company. It's not a thing. So in some industries it might be. In my industry, it's the opposite. You win by implementing the best solution, and it will not be apparent what the best solution is in inning one.
Yeah. What do you think this does to the RIA market from a fragmentation perspective? Right? We've got the big wirehouses like the Morgan Stanley with a ton of advisors. We've also got, decent-sized independent RIAs, but we have a new trend of there being more breakaway RIAs than ever. Does this create an opportunity for like more breakaway
brokers?
Like individual advisors starting new practices?
Yeah.
Do you think that this accelerates consolidation, fragmentation? Too early to tell?
Maybe it's too early to tell. I don't think so. I think there's a universe in which these tools become so common and the usage so widespread that it enables a smaller firm to hang on longer and hold off on hiring employees they can't afford. Maybe there's a world where that exists. I think, though, I think it's probably a separate issue from whether or not there's consolidation, because here's another thing about wealth tech that nobody will tell you, but I will. Once something is good and somebody has it, everybody else has it. There's no exclusivity. And when you hear about an advisory firm bragging that they're building their own in-house tech, what a nightmare. That means they have to...
Absolutely.
That means that they have to hire full-stack engineers in-house, pay those salaries, and somehow manage to keep their tech up to speed with the APIs at Fidelity and Schwab, who can turn on or off a feature.
Do you think the Fidelities and the Schwabs of the world can do that successfully, or do you think even for them?
Well, no, they're the custodian that all of the advisors rely on.
Oh, God, so if you're talking about from an API integration level, I meant more because some of them also have their own advisors.
Tech, you have to make sure that Fidelity's not going to flip a switch and knock you offline, and that's all year. And that's not just Fidelity and Schwab. If you're building your own tech, ostensibly, you're trying to connect your portfolio accounting software, which is Adapar or Orion or Black Diamond. So you have to keep that connection. Salesforce, don't get me started. The trading technology that you use to allocate accounts and rebalance. There are so many systems that have to all work in sync, and any company at any time can make a change to their own product that sends a ripple effect throughout your stack. So when you hear somebody saying, "Oh yeah, we're building our own tech in-house," no, you're not. LOL.
Yeah.
Good luck maintaining it. So our industry is very, very reliant on wealth tech and very reliant on gigantic platforms, and it always will be. So I think the way to get this right, Rex, is to wait for a winner to emerge and then use the winner, because the winner is – we're in a business of compounding advantages. The winner is going to keep their product in sync with everyone else's, because there'll be a two-way motivation in order for that to happen.
Yep. And I think I'm aligned with you. One of the questions I wear as a venture investor, and you do too because you do some venture investing in this category, is where will the value accrue in the stack? And I agree, it's very hard to tell in early innings for all of these different AI note takers and different tools who is going to win. I mean, you've said it yourself. You're like, I'm a buyer. I don't know who to buy, and I don't want to buy anything because I'm scared of the SEC. But there's another question. I'm going to talk my own book a little bit here, but I'm curious to hear your perspective on this. You mentioned custody. there's really only one new custodian who's come into market in the last few years, and that's Altruist. And they're building modern APIs. They're probably easier to integrate with. How do you view someone like an Altruist? And maybe you don't even have a formed opinion. That's okay too. In terms of they're powering a lot of breakaway advisors. They have a modern custodian platform with modern APIs that you can plug into, and so at least your custodian becomes less of a blocker to potentially integrating and building some of these new services.
Altruist is winning because they have the flexibility to do things that the larger platforms don't. The larger platforms have a lot of tech debt. They've spent a lot of money already on systems that they won't just rip out and replace every time it seems convenient to do that. And so Altruist doesn't have that baggage. Can they maintain that? Call me in 10 years. When you're a scrappy startup and you have a client who asks you to build something specific, you're like, yeah, we'll do it. When you have 10,000 clients and all of them want something different, like how do you make everybody happy? So it's really exciting to watch Jason just run the table. And
are you an investor in Altruist? I am. No. I want to disclose that. Okay.
No, but we think the world. We think the world of the ethos and the speed with which he moves, and we have a lot of friends in the advisor community who are smaller firms, and they're happy. They're happy customers.
I've talked to them, and they say I'm not in business without this, right? And and now that I am in business, it makes my life way easier.
Some of that. So let's put our cards on the table and be honest. Some of that is frankly because Altruist is willing to take on clients at an earlier stage in their development that the large firms aren't interested in. It's not quite a head-to-head competition. I think what will be interesting to see is
But that's true for other categories like Chime and all the neobanks. Even the Robo-Advisors, they took clients no one else wanted.
They created a new category. That's exactly right. That's exactly right. It'll be interesting to see if a firm like mine, I'm a $5 billion
That was my next question. What about someone like you? Yeah.
Okay, so we've talked to them, and we have relationships with Schwab and Fidelity, and we're happy, and we've built.
They take you golfing. I'm sure they take you some great golf courses.
No, we don't play that shit. I don't golf. So we work with them.
Me neither. It's one of the reasons I'm in California.
Yeah, we work with them because they are highly capable of meeting our needs at every level. And we're a firm that onboards $5,000 accounts and billionaires and everything in between. And so they are the right solution for us. If we were to open up a third relationship, the question is it with Pershing, which is kind of the old guard third platform, or is it with Altruist? And if it is with Altruist, what segment of our clientele would we custody there? It's probably not going to be the ultra high net worth. Then you've got companies, you've got Apex, who really wants to get into wealth management custody. You've got and then the next
the whole
thing,
custody layer is interesting. Again, putting my venture hat on, one of the questions is where does value accrue? And if you look at just AI writ broadly, the platforms like Google, Amazon Microsoft have seen like over several trillion dollars of market cap accrue to them, because it's going to be hyper competitive at the foundational model level. It's going to be hyper competitive at the layer on top of that of agents. But they're kind of the custody. They own and run and distribute the compute on top of the NVIDIA, who's an even lower layer, and that's super. So one of the takeaways, and I want to hear your reaction to this, look, if you have a new custodian who can actually work with and move faster towards where the puck is going, that can be a great layer to deliver not just new services, but also deliver value, and that platform itself become value. So do you think that's a fair characterization, or are there some missing links there if you look at the NVIDIAs and the Microsofts and that of the world?
Yeah. So my take on this is that the large tech platforms win no matter what. Of course, I think you're exactly right there.
I know we're earlier in the innings of what this means in wealth world, because it just takes longer for it to adopt in a regulated industry.
Here's a hard and fast rule about the financial advice business: whoever is closest to the client wins.
Yeah.
Everyone else has to accept fee shrinkage, has to accept disintermediation. If you are the one that talks to the client, if you are the one that the client is most familiar with. If you are the face, you win because you decide what you're willing to pay. All of the middle pieces.
Yep.
So
Yep.
you can kind of dictate terms. One of the
In
other
marketplace speak, what venture investors will say is aggregate demand. If you aggregate demand, eventually you can figure out supply can still be hard, but that's where you can control.
Look at the asset management business. Every year, the average fee that people are willing to pay for a fund drops. Do you know why? Because the advisors who are recommending the funds want that piece to be as small as possible, so as to preserve their own piece. So if I'm a 1% AUM fee to my clients, I can't add another 1% in internal costs in the funds that I use. So I'm going to use Vanguard at 3 basis points or BlackRock at 5 basis points, and that way I can keep my 1%. If I start adding things that cost 150 basis points, then I have to reduce what I'm charging the client, and I'm not going to do that. So that's the incentive that has driven the low-cost passive revolution in the advice world. Think about that on the software side. Anything that I do to increase the cost of doing business for my clients is coming from the money that the clients are paying me. I am ultimately the arbiter as the client touching advisor. I'm the arbiter of what I'm willing to pay for. And so the market of middleware has to fall in line. The other thing that we have is an epidemic of, I don't mean in a bad way, of feature companies that don't know they're feature companies. It's a Cambrian explosion of companies that invented a feature and are raising capital around it and thinking that they have a company. And the first thing these
and this is a problem I face as investors. I think there's a lot of people doing important work, but the question is, how big of a market is that work if you're selling a feature to wealth advisors? Because it's a big world when you look at assets. It's a small world when you look at how many different wealth advisory firms there actually are.
In my experience, about half of them get it, and their exit is to sell to a larger fintech, and then half of them really think that what they're going to do is they're going to get their nose under the tent, like with this feature, and then they're going to go horizontal and turn themselves into a platform. We really haven't seen that work. InvestNet.
It's hard. It's so hard because you've got everyone else who's trying, or even if it's not everyone else, the 10% of the hundreds of everyone else are trying the same motion.
Yeah, not everybody can be a platform, and not every feature is destined to become a company. I understand you started out as a company because that's how you capitalize it, and that's how you bring in investment dollars to build the product. But this idea that RIAs are going to want to be platformed by 10 companies, and each of them is going to do an individual trick, and then that whole thing together is the bag of tricks, and they're going to pay everybody separately. It's not great. But then we've seen the other extreme where you have InvestNet and they sell 10 buttons, and you say to them as the client, I only want to push this one button that you have. I don't want to pay for the other 9 buttons that I don't push. And they say, well, this is the platform. So I don't know what the right answer is. It's a moving target. I think the holy grail in our space is what we all want is single login. We want one layer that you log into, and all of the features are interrelated and playing nicely together. And we never quite seem to be able to get there.
No, it's super hard. I do want to touch on business model. 1% fee is like the business model of most of the wealth world. Is this new layer of tech innovation going to put that under pressure? I think the bull case for why it would create fee compression is, we're automating things. When you automate things, people will compete on price. The bear case would be, well, you're now doing more for your clients than you were before, potentially, right? So you can justify it, and maybe clients don't care. I think this is probably the biggest one, is there's just a lot of inertia in the industry, even if you're seeing a lot of change. So where do you think about business model and fee compression shift? Obviously, it's happened at the asset management layer for ETFs, but what about for advisors?
We don't have fee compression. We actually have people raising their fees in the modern era, and what we have instead is margin compression. It's not enough to do asset allocation for clients. You have to do financial planning. You have to have CFPs. They cost money. Their time is very valuable. You also have to now be able to very specifically do, at a minimum, tax consulting. And a lot of clients are now, lot of clients are now looking for firms that can actually file taxes for you. So now you need accountants in-house. It's going to a place where you're going to have to be able to do trust and estate work if you want to compete for $5 million and up households. Right now, you can outsource that. You can refer people to law firms, blah, blah, blah. Ultimately, where this is going is RIAs that have accountants on staff filing taxes and attorneys on staff literally going over legal documents. That's margin compression. The fee is the fee, not moving much. The amount of things you have to provide for that same fee is growing.
And that totally makes sense. And I think a lot of listeners can relate to that. It's like you don't want to have an asset management person and a tax person and then like a trust. It's just hard. It's hard to do. But the best business model is the 1% on assets. And so it makes sense for all those services to be aggregated under someone who can charge in that way.
Let me tell you another thing. Accountants are used to being paid hourly or on a per project basis. You can very easily afford that when you're getting the fees on the wealth management side, and then you're tacking on the tax filing fee as a separate cost, which you kind of have to do. And we surveyed our clients a couple of years ago, and we said we already had CPA level consulting in-house, but we weren't filing people's taxes. And we said, if we were to offer to file taxes for you, would you be interested? And we got a 70% plus yes response. So immediately we started hiring accountants. Now we have a tax subsidiary.
And I think historically taking on that burden is a bad idea. It's a lot of work. It's a lot of people. It's a lot of things that can get a client upset. That's margin compression. But
and
now,
it doesn't scale.
And it doesn't scale.
It doesn't scale. The wealth management scales beautifully. The stock market goes up 3 out of 4 years. The portfolios go up. Your 1% is worth more. Every 10 years, it's probably
asset
worth
allocation
twice as much.
generally is pretty easy. Like you kind of pick the plan, you stick to it, and a lot of the tools automate it. Client management, making sure they don't screw themselves, is important.
To win that business, you need to have now, to be competitive, you need to also have tax experts. Everything you do on the investment side for a client touches their tax situation. Everything.
Yeah.
Now, the risk is...
And if you look at investment returns, the most important lever you can usually touch is taxes. It's taxes, fees, diversification. And taxes is the number one, and it's the stickiest wicket.
So now here's the risk. If you underperform the market or you get a trade wrong, like you just had a bad investment idea or something, it's forgivable. If you fuck up somebody's taxes, not only are they leaving as a tax client, they're leaving as a wealth management client. They are not happy with you. You can't. So you can't half-ass this decision. Are you going to do tax or are you not? That's really what it boils down to. You can't sort of. So this is, I think, going to represent a dividing line, and not all RIAs will be able to get over that line. And I think you're going to see a bifurcation. You're going to see haves and have-nots, which is why scale becomes really important. It's really hard to hire a full-time CPA who's going to work with business owners and wealthy families, et cetera, at $50 million under management. So I think you're going to see a separation now of the firms that could afford to invest and the firms that couldn't. Yeah.
And, I asked you earlier to prognosticate a little bit about what AI means for the future of the wealth management industry. And I think we actually touched on what is probably the biggest thing. It's not about who's going to win, who's already an RIA. It's the idea that accountants and tax professionals are going to be subsumed within the RIA industry because they have the best business model.
That's right.
1% on assets. And now, for the first time, you're saying, could I do taxes for my clients without suffering from excessive margin compression and not upsetting them by screwing it up because the tools are getting better? And I think the answer to that question, you're not doing it for all of your clients. You just surveyed them. It's not yes, let's do it today, but it's more on the table than ever before. Okay. Yeah, not yes, but probably not for all your tiers, right? Like there's certain layers.
We did 500 families last year. It's a lot of work. You've got
about 4,000 is the public number I saw, like number of families you've got going.
I'm saying for the taxes alone.
Yeah.
So
no, Charlie. So 10% of your families you're doing taxes for today.
Yeah. So in order for that to scale, we need more bodies right now. It could be the case, to your point, that it's bodies and AI, and having an accountant be able to do this work for more families is the unlock. Yeah, I'm with you on that. Yep. I think you're right.
Yeah, and I think that alone, it doesn't sound that interesting because those people still exist. They're just inside of a different firm than they used to be. And I think that to me, I feel pretty comfortable about, because I think best business model wins in terms of consolidation. And to your point, owning the client and the assets is probably the best.
When you onboard a new client, and part of your onboarding is not just here's your portfolio, here's your financial plan, but you have a call scheduled next week with our in-house tax group to see if you're a fit for consulting or for actual tax filing, tax prep.
Yeah,
that's part of the business model now, and we don't have clients that are like, no, I don't want that. It's a weird thing, and I can't believe it, but it turns out the majority of wealthy families do not particularly care about the current accounting solution they have. It's not meaningful to them. It doesn't inspire them. They're not like, I have a great guy. Some of our clients do.
You know what I hear when I ask all of my friends, like, how do you feel about your tax person? They're like, I don't like them. Or like, hey, do you have a recommendation? I do not have a recommendation.
But right, and then the other thing is the degree to which it fits naturally. Like if you're doing the wealth management for a family, you already have 80 to 90% of what you need in order to do their taxes. It's intrinsic to what you're doing in the first place. It's not like, hey, we do wealth management and also pizza. Like it's literally part of what we're doing. And so that's why I think the future of our industry is going to involve both. The key is going to be to make it really clear on the tax side, we can't screw this stuff up because it's jeopardizing not just the $3,000 that we're getting paid for tax work, but it's jeopardizing like the wealth management fees that are really the whole reason that we exist.
Yeah, and that's I think, I hadn't really put this together until we had this conversation. Like one place that I had gone before is, we'll probably see some fee compression. But now I'm reorienting thinking, no, I think instead that fee will just represent more and suck more into the wealth world, which I can understand. Another thing I want to talk about, so we talked about tech innovation. We talked about business model change, which really, it's not going to change the business model. It's going to change the services you provide. I think a third thing is just changing consumer preferences and how that's going to impact wealth world. And the biggest thing here, and you're starting to see this, I'm sure, is generational wealth transfer. $90 trillion flowing from boomers to millennials and Gen Z. How is that, the younger client base, owning more in assets, starting to impact the types of services you provide, the way you show up, the way you communicate? Because that's another big thing that's we're just starting to hit the meat of.
Well, the Gen Zs and younger millennials don't read. So this is not a knock on them. The way that their lives are structured, they don't have as much time to read.
They're like your old boss in 1999 too. They're like, I don't want email. Don't email me. Right? Like that's probably one thing.
Well, they don't read. So one of the things that you've seen us do is pivot to multimedia. We're still getting the same message out. We're still doing the same content, and we're still writing. But a lot of the stuff that we write ends up becoming video, ends up becoming audio, podcast, ends up becoming social media clip.
And I certainly see this in the broader representations of the firm, like you doing podcasts, out on social media. Do you do this at an individual client level too, in terms of like, recording Loom videos for clients or anything like that?
No. We find that when people are paying us a lot of money, they want the real thing. They want to
just talk in person. Anyways.
They want to talk to you. They don't. Yeah. But the outreach that we do is in part reaching out to prospective clients, but also existing clients prefer to get updates from us by checking out the YouTube channel, or they go for a bike ride. They want to listen to the podcast. They don't necessarily want to have a scheduled Zoom meeting, but they want to hear what we think is going on. So we have, I think, staked out a claim as probably the best example of RIAs communicating in the modern mediums that young people want to consume. And as a result, I think we have like a super young fan base that are coming into their inheritance years, coming into their highest earning years. And we've been paddling in front of this wave for forever. So I don't think that it replaces the need to be a great wealth manager. I don't think you could like just do content. So the trick is balancing the two things. And look, a lot of firms, like they were told you have to do social media. So you know what they did? They gave it to the intern or the boss's daughter. Here, do some, like make TikToks for us.
Yeah. People don't
one of the few
follow
firms where the founders
companies. They follow people. Yeah, it has to be the founder. It has to be.
So I know the founders of the large RIAs. They don't want to do this shit. Like, they don't want to make podcasts. They want to golf.
And here's what I think they get wrong too. I think they can understand it's a client acquisition strategy, right? It's about communicating with the broader market. So when people think they need a new advisor, they reach out to you. But I think one thing they miss, it's not just that. It's also maintaining an open line of communication with your existing clients so that when they call you, they're not saying, hey, what's the state of the market? They already know the answer there. Instead, they're calling you, they're saying, this is my specific thing because of the state of the market you articulated to me through some content. Should I do this? And that is a better client experience.
Rex,
that's not just an acquisition.
3 weeks ago, all hell broke loose. There was a panic in the markets because of something the Japanese central bank did that reverberated around the globe. They had
the yen carry trade still sends shivers down my spine.
So the Japanese did something with interest rates that blew up some large funds that had been relying on cheap Japanese funding in order to have investments. Yep. They had to sell, and they had the equivalent of a 1987 style one-day crash in the Nikkei. And when the U.S. markets opened that morning, the VIX went to 65. A lot of investors were walking around that day saying, this seems really scary and systemic and problematic, and I just hope my advisor is looking at the same thing I'm looking at. Our clients were able to instantly watch us or listen to us or read us describe in detail why this is a nothing burger and why there's nothing to worry about. And here is not just our opinion, here's all the evidence for why. Within 2 days, we were vindicated, of course. The market had its worst day of the year and then its best day 2 days later. Okay? But the point is, that is modern wealth management. We did not have to have individual meetings with 4,000 households to calm them down.
And probably the most important job to be done by a financial advisor is to prevent people from logging into their accounts and doing something dumb when the market turns. And I'm sure what some of your competitors did is they the next day or maybe the same day sent kind of a formal email that described.
We call that a 1% letter. So at Merrill Lynch, anytime the market fell 1% or more in a day, it generated an automatic email boilerplate to all the clients.
And that feels very different than you, Josh Brown, getting on, talking about it, getting it out faster. That's just a better way.
We're not just talking. We're armed to the teeth. We have charts. We have data. We have historical references. We have multiple voices. We are bodying these situations. And you're exactly right what you said. It's not marketing. That's client retention. Our clients know they made the right decision because we're all over this stuff.
Yeah, and you don't have this data because you haven't got an academic involved, but I'm sure you could look at trading for your firm versus other firms, there's probably real hard data you could show that it's also not just retention, it's literally helping them make the right decision in a scalable way, which is interesting.
We have clients that have been mainlining our investment philosophy for over a decade, and when the market had its fastest bear market ever in March of 2020, we had clients calling in, how can I get you guys more money? I want to buy more. It's the opposite of what the impression that most people have of. People think retail investors are these idiots that just haplessly sell at the bottom, buy at the top. It's not true. At least in terms of the type of investors we talk to. Our investors are savvy. Think about how they found us. They're reading financial blogs. They are the top 1% of investors. And not only are they not hapless idiots, they're really smart about taking our message and internalizing it and acting on the things that we say. And it's a really good feeling to have your clients call you and say exactly what you would say. And as a result, we were not dealing with mass panic. we're dealing with people that like want to capitalize on it. It's really cool. And, you know, it was a really big investment of time to get people to this place. But that's where we are.
Yeah, I agree. I think, you know, the whole thread we were pulling on was how do you deal with this wealth transfer, the rise of millennials, Gen Zs actually owning assets. I think your point is the number one job of financial advisor is communication. And so it's not surprising that how you communicate, and specifically in this case, producing content, is going to be a big part of.
Let me get very specific because this is important. There is no piece of content that you can put out. I don't care if it's written, spoken, performed, if it's interpretive dance. There is literally nothing you could film or publish that's going to get somebody to say, oh my God, I want a financial advisor. The way it really works is this.
Yeah.
You cast a wide net with your content. We don't call it content, we call it intellectual property. You build a fan base in the millions, and then you let life happen. And every day, somebody from among that fan base, their father dies and leaves them $4 million. Their boss calls and gives them a promotion. Their boss calls and lays them off. They get engaged. They get married. Yep. They're pregnant. They are about to sell a business. Some catalyst. It's not about me. It's not about you. It's about the people. They have a catalyst in their life, and they say, this is a lot of money, or, oh my God, this is a traumatic time period in my life, or something, I need help. And you know what happens? You are front of mind as the content creator who has been educating them all this time, and you've built this relationship, and they say, I'm going to call those Ritholtz guys. Now is the time. And that's our clients. And you can't force that. You can't send the killer email. There's no silver bullet. You can't make people want to hire you. You must become trusted. You must provide a ton of value. And then, in their moment of need, you are the only solution they're interested in pursuing. And that is the story of how we built the firm. I wish there were a trick, a secret, a hack. It's not. It's be honest, be helpful, give, and it comes back to you in ways that you cannot even imagine. And you have no idea the asymmetry of this thing. You have no idea who's listening. It could be the king of Siam, right? So we've had these moments where people have called us and said, oh yeah, I've been listening for 5 years. So you have a...
Don't you have better things to do?
You're an Emmy award-winning actor. What do you mean you're listening to our... But like this is what happens. And so it's you got to play the long game. You can't rely on tricks and hacks and SEO. It's not going to work. If you really want to do this, you have to be committed to doing it. Yeah.
One other trend I want to touch on is mass affluent and what's going on. You've talked about how advisor communicating with client is one of the most important jobs they can do. But there's a whole category of advisors who pride themselves on not communicating, at least in a human way, Robo-Advisors, right? I know you've said rich people don't want to talk to robots, totally get that, north of $1 million, $2 million investable assets. But if you look at Robo-AUM, it's gone up, call it 20x in the last 5 years. And it depends on how you look, but it's growing a lot and seems well suited to the 250K to 1 million. I mean, you even say you have your own Robo product. How do you think about squaring like client relationship management, but also with the robo-advisor, understanding that this is a different segment of the market than what most advisors are serving?
So this is important. The money sitting at the large robo platforms, at Vanguard, at Schwab, at Merrill Edge, it's not new money that fell out of the sky when they launched.
Yeah.
It's the money they used to service with a 1-800 number. All they did was recategorize the small clients and push. Now, instead of a 1-800 number, you get emails from us. It's the same. It's just a more efficient way.
I totally agree with that. A lot of that is recharacterization. But I think even if you look at the growth of some platforms, like they're hitting like $75 billion in AUM. Average assets per client is on the website it says about 1 million clients, so it's about $70K, and it's growing. And they've talked about their revenue base. It's hundreds of millions of dollars, growing well over 50% year over year, and at north of 50% EBITDA margins. That's not a bad business. It's still tiny compared to the size of the RIA market. But I'm curious if you think, how you feel about the robo category generally. I totally agree. A lot of it is recharacterization, and the biggest asset levels.
So we know there's only two standalone Robo-Advisors. One is Betterment, the other is Wealthfront, and the rest are gone. I bought the one that BlackRock acquired. There is nothing else. There won't be
Was
a
that
third.
Future Advisor or
Future Advisor? We brought it in house and we made it human. We have a team of CFPs who work with those clients. They're sending us way more money than they ever would have sent to Future Advisor. And BlackRock recognized that what they wanted to focus on was the institutional client and B2B. We are in the B2C business. It was a really great situation for everyone involved, and the clients, by and large, are now being spoken to by human CFPs, and we're doing financial planning work for them. It's so far beyond just we'll do 7 ETFs. That's where that business is headed, is convergence. Betterment has human financial planners working there. Wealthfront is really the last of the companies that are hanging on to this conceit that what people really want is convenience and speed, and they don't want human connection. They definitely carved out that niche for themselves, but honestly, is it a great business? They tried to sell it to UBS, and UBS paid a breakup fee rather than go through with the deal. Betterment hasn't been able to come public yet. And all of the other ones are gone. So is that really like the business that people want to be in? I'm not 100% sure.
Yeah, and I think there's a question about like how big is that niche, right? And maybe there's enough for one player. They have probably a $4 billion company if you do like a premium multiple with that growth rate. But anyways, I think, but I do think there is also this.
The problem with it is it's asset allocation, and as we know from the fund world, which we talked about, asset allocation it's a shrinking compensation. So the standalone robos are effectively 25 basis point businesses, and if
now there's some robos that are just subscription only, right? And so
all right, so nobody else wants to do that, so they can have that niche. I don't know if a lot of people that are dying to be in that business. So I think where things settle out is it's a convergence of the Betterment has the best robo technology in my view. And they work on it, and they're thoughtful about it, and we utilize them as our platform. We are closest to the client, though, and if we tell those clients what we want them to do and what they need to do, and we're giving them advice, that's our relationship, and the technology is the technology, and it's a great setup. Betterment makes money, we make money, the clients are happy. There's nothing wrong with that.
Yeah, this has been an awesome conversation on all the avenues of wealth, how it's changing, how AI is changing it, how generational change is coming. I want to just have some fun questions towards the end on not investment advice. So first, do you own Bitcoin? Do you advise people to own Bitcoin?
I own Bitcoin. We don't advise people to own Bitcoin. We've made crypto as a sleeve available to them if they want it, but we don't call people and say you should really buy some crypto.
Yeah, it's they call you and you say okay, and then you probably say like 1% to 2%.
I'll be honest with you, nobody really wants it. Maybe at Bitcoin 100,000, but like wealth management clients that are over the age of 50, if they haven't gotten it by now, they probably won't. The next generation really wants it. They are not the bread and butter wealth management client, so it's going to take some time. But I do think ultimately it will happen. I do think ultimately this will be a non-correlated asset class that the majority of wealth managers have some involvement with, but it's
although
not
ironically
the
correlations have converged more recently as it's gotten bigger.
It's going to be glacial, and that's fine. What's the rush? It's not like like any of this is going away. So
totally soft landing, no soft landing,
no landing,
no landing,
no landing, no landing. It's over. We're cutting rates. So it's over.
Economy's still growing. AI will deliver.
You could have a recession,
gains.
but we had a no landing.
Yeah. Most underappreciated investment advice?
Pay less attention. Here's my best investment advice. Lose the password to your brokerage account.
I was going to say the same thing.
Deliberately type in nonsense on the keyboard, then copy paste into the confirm password, hit enter, and just forget it. That's really how, nobody wants to hear that, but of course that's why it's the truth. If you just did one thing, limiting your own access to the screen is probably the most helpful thing that you can do. And the proof that we have of that is people's 401k portfolios outperform their brokerage accounts. We know this.
Yep.
We know this.
It's amazing. So. The one caveat is make sure it's invested in probably some sort of target date fund, and it automatic reinvests, because Vanguard just did a report where they showed that like 10% of 401ks aren't invested, and the clients don't even realize they're not invested. So they're doing everything right, except they forgot the crucial investing part.
You
cool.
can't forget it before you said it.
Yeah. And then last thing, you have a book. Tell us about that and how else to connect with you.
The book is called You Weren't Supposed to See That. And if you've enjoyed listening to me for the last hour say things I'm not supposed to say, then you will definitely enjoy the book. It's basically me chronicling the last 15 years of market history, but bringing everything up to modern times and trying to extrapolate the things I've learned into what's going to matter in the future. And had a ton of fun writing it, had even more fun recording the audio version. So if you're not sick of my voice by now, that's another way that you can consume the book.
Awesome. Cool. Well, this has been an absolute pleasure. Thanks so much for coming on and talking to me.
Dude, you're the man. Rex, thank you so much for having me. Appreciate it.
All right. Take care.